Welcome to this Killick Explains video all about contrarian investing. Now, in volatile markets, some people may see an opportunity to be what is known as a contrarian, but it's not as easy as it looks, or we'd all be doing it. So here are 3 tips for anyone tempted to take advantage of volatile stock markets. Now, Warren Buffett talked all about the contrarian ethos, and he summed it up as being greedy when other people are fearful, and fearful when other people are greedy. In other words, what you want to do is to buy low and sell high at exactly the point when other people are doing the opposite. So when everyone else is panic selling, you want to have the presence of mind to buy. And when everyone else is buying, maybe that's not the time to join in. Because if you think about it, although following the crowd sounds logical, if you do follow everybody else, you'll end up buying high and selling low. And that's not a good way to make any money. So, contrarian investors are people that tend not to follow the crowd. They tend to do the opposite, and then they wait for what they're doing to come good. In other words, they wait for everyone else to realize that in fact they were right and everyone else was wrong. So here are 3 tips for anyone who's tempted to become a contrarian right now. Now, number 1 is don't follow the crowd, all right? Do your homework, don't follow the crowd, and don't buy or sell indiscriminately. In other words, it is not a simple matter of saying nobody's buying this stock, so I'll buy it, or everybody's selling this stock, so I won't, because sometimes the crowd are right. So to be a contrarian, it's not as simple as just watching what everyone else is doing and just doing the opposite, all right? Yes, you're not going to follow the crowd, but you're also not going to buy or sell just anything on the basis that you're doing the opposite of everybody else. You need to actually do some homework. You need to monitor key ratios, all right? So you need to be prepared to get your sleeves rolled up, do some analysis on financial statements, do the hard work, properly identify when a company is cheap and when it's expensive. Look at what short sellers are doing. Look at what people who bet on prices falling, if you're looking to get in and buy, look at what those people are up to. Look at short selling activity. Look at the pattern of behavior, because when those people get heavily into betting on a stock falling in price, that could be, I stress could be, a good time to get in. Look at trading volumes. Is this stock being traded a lot? In other words, is the momentum behind a stock in either direction evidenced by trading volumes? And look at sentiment. Is there evidence around that people are very, very bearish or very, very bullish? Because contrarians will look to stack up all these factors, key ratios, short selling interest, trading volumes and sentiment, and build a picture as to whether a stock is oversold or overbought, and therefore whether they should get in or get out, if you like. Rule 2, do not be greedy. Now, this applies to all investors, certainly applies to contrarians. All right? And what I mean by that is the best you're probably going to do as a contrarian, if you're looking to buy when a stock is falling, so you're looking to get in when it's cheap, is the point here, don't be too greedy. You're probably going to get in at maybe 2/3 of the drop, because no one rings a bell when the market hits bottom, no one rings a bell at the top. There's no signal out there that tells you the market has bottomed out or topped out. So you need to use judgment. Now, you're not going to get in right at the bottom, other than through sheer luck, frankly, because everyone else is trying to do it. You're not going to get out at the top because everyone else is trying to do it. So basically set some parameters. So, for example, I'm prepared to get into a stock when I think it's gone 2/3 of the way through its total fall. Or I'm prepared to get in on the opposite basis at a certain point in the cycle, because you're never going to time the beginning and the end of a cycle successfully. Number 2 is the KISS rule on don't be too greedy. Keep it simple is the rule, all right? And basically what I mean by that is get into positions that you understand. You know, don't start buying stocks you have no clue about simply because you think it's a contrarian thing to do and it might be cheap. You know, stick to your knitting, in other words, and do not deploy leverage. Don't try and magnify your potential gain or loss. Don't get overconfident, in other words, don't get greedy, all right? You'll do well enough if you've done your homework. You get into a stock when it's relatively cheap, maybe hasn't hit the bottom, or you get out when it's relatively expensive, maybe hasn't hit the top. Don't try and magnify those profits using derivatives unless you really know what you're doing, and certainly don't try and do anything using debt, for example, to fund your trading activity or anything crazy like that. So rule 3 then, admit defeat. Contrarians have to be super honest with themselves. All investors do, but it's vital as a contrarian you don't kid yourself that you're better at it than you actually are. There's a famous quote that the market can stay irrational longer than you can stay solvent. So if you put a bet down as a contrarian investor and the crowd just won't play ball, they just don't realise that the stock market should no longer be going up or should no longer be falling, you may have to cut your position. You may have got your timing wrong. You may not be able to hang on in there long enough to see your profits come to fruition. So what I'm saying is, yeah, patience is a virtue as a contrarian. You may have to wait for the market to catch up with you to realise that you were right to go in and buy when everyone else was selling, but laziness is not a virtue. So don't just hang on to a losing position simply out of apathy. And that goes for anyone, whether they're a conventional investor or a contrarian. And finally, avoid some of the psychological safety nets, as I call it. So people will always try and justify an investment decision. Contrarians do it. They'll say, no, I know I'm right, but are you right? In other words, avoid things like anchoring, which is hanging on to information which is out of date. So saying things like, well, I'm not going to release my position as a contrarian until I've got back to break even or what I paid. Well, the facts might have changed. That may be an irrelevant price point now. Confirmation bias, we all do it, looking for data that supports our position, and contrarians are bound to do this because if you think about it, betting against the crowd is tough, all right? So you've got to be pretty confident, but that's not the same as just looking for evidence to back your case. Hindsight, yeah, I know the past can be some sort of guide to the future, but don't justify your investment decisions using hindsight, justify them using information that's available to you now, and don't get cocky, don't get overconfident. Just because you got in to a beaten up tech stock when everyone else was selling it, don't assume necessarily that was pure skill. Analyse that decision, ask yourself the question, was I a little bit lucky or was that down to my superior analysis? So my advice is this, being a contrarian investor can be incredibly rewarding, all right? But it's also risky, and if it was simple, everyone would be doing it. So if in doubt about contrarian investing, keep snout out, as I put it. In other words, if you don't think you can stick to my 3 golden rules, then it may be that backing contrarian hunches, if that's all they are, isn't the right way to go. Now, I've covered a lot of jargon there, so if you'd like to know more, we have a whole video suite. That is killick.com/learn. The shares tab on this side would be a good one to go for. And if you'd like to read a bit more about equity investing in general, I've got these how-to guides available. There is a blue one, which isn't next to me, which is all about equity investing. So do ping me an email, editor@killick.com. And if you'd like to understand a bit more about investing and contrarianism in the context of real-life decisions about investments, funds, shares, bonds, then do ping me an email, editor@killick.com, for a copy of the magazine next to me called Confidant.